What's up? What's up? So I want to do a quick video. You guys have heard me talk about how I'm adding futures content to the trading suite, and I know it has been some time. I've been trying to record this for a while, and you might find it's a lot easier than what you think. It's a completely new asset class, that's for sure. So I want to just explain the differences, the pros and cons. We're going to use just the S&P. There's futures for everything, but in this example, I'm going to explain futures. We'll go over the ETF, and then just I guess some extra stuff, right? Uh, so there's again, we're gonna use the S&P futures and ETF. Both are investment products, so they allow you to trade or gain exposure to the S&P 500. You see it both appear on screen right now. I got the futures up top, the ETF on the bottom. There are some key differences that everybody probably should be aware of. I know I like to paint a picture that futures are much better. They are, but just some things you probably shouldn't ignore. So first and foremost, the futures contract is agreement between two parties to buy or sell an underlying asset, at a predetermined price at a date in the future. So there is some leverage in this, so you can control a large amount and spend very little. This is where you get to spend less and make more. I'm not a fan of that conversation because I feel like every pyramid scheme starts with that, but that's just leverage in general. And that's what does make this very popular. Now, this is probably a lot more popular for institutional investors or experienced traders, which we'll get into that. So one of the advantages, again, is they're highly liquid. It can be traded 24/5. It's actually 23/5. So they take a break 1 hour a day. It's 6 p.m. Eastern time. That's not the cool time. I'm in Central time. No, they come back live. Yeah, so Central Time for me, they close from 4 to 5 for me, so it's actually 5 to 6 Eastern, what everyone else calls the normal time. And that is Monday through Friday. They close Saturday, and you guys know for the YouTube streams, we break them down. We go over them. They open up Sunday evening. So you can react quickly to any, market move, any news after hours. You can manage this basically around the clock. So there's not a lot of gapping going on here. Which you can get into with the S&P. Not a lot of rolling the dice, which is one of the pros of this. So they're highly standardized. Not that this means a lot to you guys, but across all platforms, they have the same size, same expiration dates. So it does make it a lot easier to buy and sell these things. For you guys, most of you guys think the world of stocks is just magic, and all the dealers are the same. So every broker's the same. That being said, behind the scenes, they are the same. It is standardized. The disadvantage, though, again, it's the degree of leverage, which can, you've heard me say this before, magnify profits and losses. If you're good at something, adding leverage will make you great, but if you're good at losing, you're going to be fantastic at it later. Like with options contracts. So options contracts, now futures do have options. We'll forget that for now. Options in general, a lot of people have heard of. You get to buy 100 shares, right? So if you suck at something now, you're going to suck 100 times faster, when it comes down to your trading when you switch that asset class. Now, one difference here is with futures versus options is you can lose more than you bought, if that makes sense. This is one of the trades. You go rocking this without a stop loss, and you get an invoice, not a red day. So not particularly fun. I guess in general, this is a little bit more complex than other trading. You can just go on Robinhood, click buy a stock, which you might think an ETF is a stock, SPY is a stock, and you get some confetti down from the top. You need to know a little bit more when it comes to trading futures. So maybe not what you want to jump into day one, although there's going to be some pros, I guess, to going day one. There's a very serious pro, and it's something I actually don't really agree with later. We'll get into that. All right, so let's get down to the bottom, the ETF. So this is SPY, an exchange-traded fund. So type of investment. So it trades like a stock. This one's designed to track the performance of the S&P 500. So when you do buy shares of this, you're essentially buying the whole basket of stocks, the top 500 companies that are in the S&P 500. This is generally less risky. This is for index fund investors. They say it's about time in versus timing. Historically, this tells us if you hold this, eventually you will be up. There hasn't been 10 years where it has gone down, a 10-year cycle. We've gone through lost decades, bad years, good years, but over those 10 years, you typically do go up. So if you tell me, Don, I'm going to buy this, I'm not going to have a stop loss, and I hope one day to sell it for a profit. The S&P, you could probably, as far as history goes, you can do that now. Futures, no. Yeah, you're going to get rocked on that. You can be very rich or very poor. All right, so I guess it's less risky as futures because they don't have leverage in there. So again, this, I guess the thing could get delisted. You just lose what you have. There's no invoice option, provided you're not going margin or anything like that. Broker will likely close that down, probably getting into more complicated topics anyway. So for the less experienced traders, that SPY ETF, one of the easiest ones to trade. And I know people that make full-blown incomes off of just trading SPY. You'll hear me often say it's a terrible way to do things because when you understand both, and I'm not trying to get you guys to jump into a whole other asset class, but when you understand this, you start talking about capital efficiency, it's ridiculous to trade SPY versus the futures. So disadvantages of trading it, I guess I don't know. I guess technically they're not as liquid as people will tell me. I even tried looking this up, like what's the disadvantage of SPY over the E-mini futures, and it came up with not as liquid as futures, which I don't know why that was number one. I thought that was kind of silly. The big one for me is it can only be traded during hours. For me, it's 8:30 to 3, so I guess 7:30 to 2 to 4 for all the other. No, you guys are an hour ahead. I don't know. I'm in Central Time. Let's just keep it with that. 8:30 to 3. You guys know your time. When the bell rings, the bell closes. I guess when the bell rings, it opens. The bell rings again, it closes. Those are your hours. That's that. You got extended hours. You can trade it pre-market, after hours. Typically a lot less volume in there for sure. Now the bid and ask will get quite a bit wider during that time too, so your fills aren't technically as good. We're getting into the nitpicking right now. But you've heard me say this a lot in my streams. They don't always track the underlying perfectly. And you've heard me say this a lot. It's the reason why I zone out the top one, the futures. That's what drive order flow into these ETFs. You guys see a bunch of gaps here. And I love to make fun of people talking about a gap fill on an ETF because they're absolutely clueless to the fact is what drives this. There's no actual gap on the S&P. It just traded, and your ETF is going to play catch up in the morning. You know, and that's it. That's why I say it's like reading a book. The S&P, the E-mini up top would be like reading the whole book, versus SPY would be like reading a book with all the odd pages. Just the odd pages, that's it. You got a pretty good idea of the story. You know you're not supposed to say Voldemort. You know Harry Potter wins in the end. But you probably missed out on a few good details. That could be rather important, especially when you put your money into it. Don't you want to have all the details you can? All right, so when it comes to capital allocation, that's a big one for me. Just because of the leverage, this is what makes it popular a lot for institutions and anything like that. Again, you gain more, you lose more. So the E-mini right here is worth 50 times more than the S&P. So let's take that. Let's just, for simple math, let's say they're both at, no, the S&P is just 1/10 of that. But let's just say we got, we'll call it 410. So we're at 4,100 times 50. You're controlling a $200,000 position. Now, one E-mini contract is going to cost about $11,000. Now, if you want to compare during the day, during the time you can trade this, there are what's called day rates in a lot of brokers, and that $11,000 is actually $1,100. It's 1/10 the price. So for $1,100, I'm controlling a $200,000 position. So money out of my pocket, all I'm seeing is $1,100 go away. In theory, again, you can lose more than the $1,100. That thing starts dipping, you're going to lose more than $1,100 real quick. But $1,100, my position is going to move at the magnitude of a $200,000 position in the S&P. But if you want to buy, just let's say the S&P, say for the same thing, we got 410 shares, $410 a share times 50 shares. Boom. So you need 20 grand just to buy it in there. So 20 grand versus my $1,100, and we get the same movement. The 200 grand part is again, because we're buying the SPY, not the actual S&P, which is the 4,000. The SPY is considered the poor man's S&P because it is 1/10. That's what a lot of you guys are trading. But see the capital you have to put up. You have to put that up just to make a little bit. Where I'll put up a significantly less amount and make the same. So as far as capital allocation, let's say, hey, Don, I'm out to get 50 shares of the S&P. Do I want to tie up 20 grand in my account? What if I only had a $20,000 account? One, I can't day trade it because we're going to get into PDT here in a second. But two, that would be all of my account. Do you really want to be 100% allocated into an account? That's reckless. I know we're talking about the S&P, but that's just a reckless thing in general. Yeah, shout out to Stephen Mark Ryan in his Tesla position. Reckless. But I guess he knows where he stands. He knows, no surprise for him. All right, so one of my biggest problems with what makes this so easy and fun and not fun at the same time is the pattern day trading rule. So for under PDT, which means under 25,000, you get 3 day trades in a rolling 5 days, and you get to buy. It's talking about money exchanging. You can buy, your money goes out, and then your money comes back in all in the same day, one trading session. That is a day trade. Now you can buy everything you want 1 minute before the market closes and sell the next minute the market opens. That's a swing trade. You held it overnight. Do that as much as you want. But the day trade, money out, money back in, 1 day trade. You guys get 3 of those in a rolling 5 days. Not a whole lot of action to do there. Now, because people suck so bad at trading, that was a rule that was implemented because they were losing so much, it was actually affecting the markets. Now they figured, hey, if you don't have that much, you can't afford to lose that much. I don't know what their thinking is. But in reality, if you can't make money with 3 trades, I always say, what makes you think you can do it with 3,000 trades? But that only applies to SPY. Futures don't have that. So now I can spend less. I can have a smaller account. I can get the action, the price action of those big YouTubers you guys follow. Make the big bucks. Smaller, no PDT, so I can play the in and out game. I don't have to swing overnight. I don't have to hold positions and roll the dice for some crazy tweet or something to happen in the overnight market. I can manage it around the clock. The only downside is that leverage aspect. If you guys don't know what you're doing with your money and you get carried away, the broker will close your position for you. They don't like sending invoices. They will close that account for you, but sometimes things can happen. And I like to plan on worst case scenarios, and those don't pan out very well. And if worst case scenario would happen, it gaps down, runs. That broker can't close it in time. They're going to say, hey, we tried our best, we closed it as quick as we could, but you owe us some money, which would be devastating to a new trader. I've seen people not have stops on, and overnight, gone. They woke up to their account 100% gone, completely liquidated. So not a fan of that, because those are mistakes that brand new traders make, and this is one of the most attractive thing to brand new traders is the PDT rule. It was designed here to protect us, but it's going to funnel people into something like this and get kind of crazy, because honestly, if you're starting off the bat, the SPY, one of the easiest things to trade and get a hold of, and once you've mastered SPY, one of the easiest tickers to trade, I think, then you switch into this. Again, I know people that only trade one contract, full-blown livings from it. Multiple people, and that's all you really need to. I mean, guys, so you see this moving up here, so this is $4,100. Now this moves in 25-cent increments, and every 25 cents is $12.50. You get a 2% day in SPY, you're rocking hundreds. Okay, like you're moving. A CPI report was a $10,000 trade for me off of one contract because it just went nuts, dropped down. Awesome. What if you were on the wrong side of that trade and didn't have a stop because someone didn't teach you stops? They told you to do some hypothetical one where you set an alert and you just get blown out. Anyway, I don't know if there's anything else. Yeah, pros and cons. Again, we got the leverage of futures, which is a pro and a con. Then you got the a pro up here is hours. Unlimited. You close for an hour, go take a coffee break. Versus open to close. Roll those dice and see what happens overnight. If you were a big fan of, if you were in the markets during the Trump era, that guy would turbo tweet away and his tweets would move markets. It's not like Biden's. We don't even care about Biden's tweets. Trump's would move the market. You wanted to be in something like futures for that aspect. But anyway, I'll wrap it up here. Again, yes, I am uploading futures content into the trading suite. Well, when it's done, it'll be on its own as well. That is the Teachable link down in the description. And to kick this all off, I did 30 spots for the lifetime into my mentorship, which is the Patreon link. If you do get the trading suite, use coupon code LIFETIME. There's already been a few. I know there's at least 20-ish, 21 left. Anyway, use that. And that'll get you in lifetime. If you do use that, watch out for my email. That's how you get access into the mentorship. That is the daily streams, the private chat, everything we do in there. But hopefully you guys learned something from ETFs versus futures. Which one would suit you better? Ultimately, that will come down to that, because these can move. It can be kind of spicy at times. This can be very chill. And if you're only in shares and you're telling me you're going to bag hold till the end of time, what you're really going to lose there is opportunity cost. To some people, they like that better. Ultimately, you got to play a game of Cupid, matchmaker. Which one best fits your personality, and understand what you're putting up to make what kind of amount. If we were to put up the same amount, I am going to lap you and destroy you in the S&P futures. What I like to do is spend less to make more. That's how I liked it. That's what I call capital efficiency. Some people will go at it full blown. I'm going to spend 20 grand here and 20 grand here, and you're going to see the gains on that one and potential losses as well. Anyway, I'll wrap it up here. Let me know in the comments down below. Did you learn anything? What else do you want from me? And I will see you guys in the next video.